So here indicate that there is no quick corrections when price changes cause their debt ratios to change. So it doesn't support trade-off model. So we can't expect the immediate impact concerning the trade-off benefits. After big stock price run-ups, debt ratios falls, but firms tend to issue equity instead of debt. Inconsistent with trade-off model, inconsistent with pecking order explanations, consistent with windows of opportunities. When there are different opportunities available in the market, then in such a case, that may contradict with the trade-off model, that may contradict with pecking order theory. Because the market emerge different opportunities. Many firms, especially those with growth options and asymmetric information problems, tend to maintain excess borrowing capacity. When the companies have more investment opportunities, for example, banking sector companies, they have more growth options are there. In such a case, they tend to maintain excess borrowing capacity. Implications for managers: take advantage of tax benefits by issuing debt, especially if the firm has high tax rates, stable sales, less operating leverage. So concerning the company level, the cost and benefits, the managers may take different actions. Avoid financial distress cost by maintaining excess borrowing capacity, especially if the firm has volatile sales, high operating leverage, many potential investment opportunities, especially special purpose assets instead of general purpose assets that make good collateral. So with that particular investment values, there are different collateral value of assets, collateral assets, different kinds. Then they can use this kind of special purpose assets. If managers has asymmetric information regarding firms' future prospects, then avoid issuing equity if actual prospects are better than the market perceives. Always consider the impact of capital structure choices on lenders and rating agencies' attitudes. Then now, last point is that optimal capital structure examples. Currently is all liquidity finance, no debt capital. Expected EBIT 500,000 rupee. Firms expect zero growth. 100,000 shares outstanding. Cost of equity capital 12%. Market price per share 25 rupees per share. Corporate tax rate 40%. Beta value 1.0. Risk-free rate 6% rate. Market risk premium 6% rate. So in addition to what we discussed earlier, the different parameters, here indicate some additional parameters. EBIT level 500,000. Growth rate is 0. Shares outstanding 100,000. Cost of equity 12%. Market price per share 25 rupees. Tax rate 40%. Beta value 1 rupee. 1. Risk-free rate 6%. Market risk premium 6%. Why the beta values are F rate market risk premium factors are given? According to capital asset pricing model, the company cost of equity can be calculated here depending on the CAPM model, RF plus beta value multiplied by risk premium. Risk premium is market return minus risk-free rate of return, RF. So this part is market risk premium is 6% rate. Beta value, they indicate the 1. Market risk-free rate is 6% rate. Then we can estimate the cost of equity 12% rate. RS equal 12% rate. Using the CAPM model, we can estimate the cost of equity capital. Then the minimum return is equals to risk-free rate, 6% rate, plus beta factor here, 1, because no debt capital here. No debt capital, then beta factor is 1. Then the risk premium is market return minus risk-free rate, that is 6% rate here. Then the cost of equity capital is 12%. So in some other cases, some companies declare dividends. Some companies don't declare dividends. In such a case, if the company doesn't declare their dividend payment, but in such a case, we can't estimate the company cost of equity capital. Then we can follow the estimation process based on the capital asset pricing model. Then you can gather information relevant to risk-free rate, what is the company level beta factor, what is the market risk premium, risk-free rate minus market return. Based on that, you can calculate the each company's cost of equity capital. So dependent variable is the company level beta factor here. One company may have 1, other company may have 1.2. It means it has some debt capital here. Likewise, there are different beta factors. Estimate of cost of debt capital, here indicate different debt proportions, different capital structures here, because the capital structures, debt capital 0%. It means all liquidity. No debt capital. If the company increase the debt capital to 20%, then what will happen to the debt proportions here? Equity proportions. Percentage of equity. So in first case, 100%. Second case, 80%. Third point, 70% equity, 30% debt capital. Next one, 60%, 50%. At this initial point, at the debt capital is 0%, we can find some particular debt capital. So here indicate the no information. At 20% debt capital, it reflects some particular rate at 8%. If the company increase this debt level to 30%, then the demander or the providers, they expect some higher return. Then the rate is 8.5% rate. If the company increase the 30 to 40% debt capital, then again further increase in cost of debt capital, 8.5 to 10% rate. If the company increase to 50% debt capital, further increment in cost of debt capital, resulting cost of debt is 12% rate. If company recapitalizes, debt would be issued to repurchase stocks. So here indicate the repurchase in stocks, they increase the debt capital. Repurchase 20% equity capital here, repurchase another 10%, repurchase another 10% likewise. When they repurchase the stocks, then increase the debt capital. Argument is they reduce the 10% debt and increase 10% equity capital and increase 10% debt capital. Recapitalize. The cost of equity at different levels. So you have to understand here when there is an increase in debt capital, company debt level, different debt and equity, then the cost of debt can be increased here, like here. The second point indicates cost of equity at different levels of debt. Hamada's equation. So Hamada equation here indicates Modigliani-Miller theory implies that beta changes with leverage. BU, it means unlevered beta, is the beta of a firm when it has no debt capital. We call that unlevered beta. Unlevered beta is normally 1. Then the levered beta equals here, ultimately, BL equals unlevered beta multiplied by this particular portion. This is the Hamada equation. The contribution of the Hamada equation is this part. 1 plus 1 minus tax rate multiplied by debt and equity proportion. Unlevered beta multiplied by 1 plus 1 minus tax rate. That is easy to remember. 1 minus tax rate, if the company tax rate 40%, then here value becomes here 60.6. Unlevered beta, if it is 1, 1 plus 0.6, if the debt and equity combinations, maybe debt 20%, equity capital 0.8. So different proportions here, the value can be different. At 30% debt capital, this proportion may be 0.3 into 0.7. Both should be 1. Capital structure here. 30% debt capital, 70% equity capital. Then understand here, Hamada contribution is this part. Leverage beta can be estimated based on unleveraged beta multiplied by 1 plus 1 minus tax rate multiplied by debt over equity. Cost of equity for weighted value of debt at 20%. Use Hamada's equation to find beta. So here indicate proportion of debt capital is here 20%. Then here 20%. Then the equity proportion becomes 80%, remaining 80%. If the tax rate is 40%, 1 minus 0.4, then the beta factor is 1.15. So at different proportions here, we can replace different values, 20%, 30%, 40%, 50% likewise. Then it becomes 70%, it becomes 60%, it becomes 50%, likewise. So what will happen if there's increase in debt capital here? More debt is there, then more beta factor is there. Use CAPM to find the cost of equity. So at different the beta factor here, we can find the cost of equity capital at different levels. Risk-free rate 6% rate, unlevered beta taken from here 1.15%, market risk premium 6% rate. Then cost of equity becomes 12.9% rate. So what will happen when there is a increase in beta factor here? Then cost of equity capital becomes higher. When company take more debt capital, then the company's cost of equity capital shareholders, they expect a higher return. Taking that here indicate the cost of equity versus leverage. Debt proportions, debt over equity. Leverage beta, levered beta. If there is no debt capital for 100% equity, beta value is 1. Cost of equity 12%. At debt capital 20%, then DS. Here indicate the 2.2 divided by 0.8. It becomes 0.25. Then if 30% debt capital, 0.3 divided by 0.7. 0.4 divided by 0.6. 0.5 divided by remaining equity, 0.5. Then the debt base equals 1. Then at different levels, based on the CAPM model, we can estimate the beta value, and then we can estimate the cost of equity capital. Now see, when there is an increase in debt capital here, increase 0, 20%, 30%, 40%, 50% likewise, then ultimate result would be here 12% to 15.6% rate. If the company raise more debt capital, then the company shareholders, they expect high return because the company bears some risks, debt, financial risk. Weighted average cost of capital for 20% debt capital. WCC here, 20% debt capital, 1 minus T, 0.6, plus weighted value of equity capital, either the cost of debt capital, plus weighted value of equity, 80%, remaining 80%, then cost of equity capital, 12.9% rate. Then weighted average cost of capital, 11.28% rate. So at different level here, we can estimate cost of capital also, WACC. Based on the CAPM model, we can estimate the cost of equity capital. Based on the Hamada equation, we estimate the leverage beta, levered beta. Repeat this for all capital structures under consideration. Then WCC versus leverage. Then at different debt level here, 0% debt, 20%, 30%, 40, 50. Cost of debt, 0, 8%, 8.5%, 10, 12%. Cost of equity capital, 12%, 12.9, 13.54, 14.4, 15.6. Weighted average cost of your 12%, 11.828%, 11.01, 11.04, 11.4%. Then you can observe here, there is an increase in debt capital, increase. At the same time, we can expect the debt provider, they expect the high return. Then their rate is higher, at high debt level. When the company raises more debt capital, the risk is borne by the company owners, shareholders. Then, when the company raises more debt capital, the investors, the shareholders, they expect the high return. Due to that reason, their cost is higher here. Then, at the same time, taking the particular company cost of capital, their weighted value, cost of debt capital, weighted value of equity capital, cost of debt equity capital. Based on this, the WACC formula, weighted average cost of capital becomes here 12%, 11.2%, 11.01, 11.04, 11.4%. From this total cost of capital here, ultimately we can find here 12% to 11.01%. Then again increase 11.04, 11.4% likewise. Then company cost of capital is behave like a debt and equity capital, WCC. Then there is a minimum cost point here. That level is 30% debt capital. Minimum cost is there 11.01% rate. So this is the optimal capital structure. So at this point, what would be the corporate value at this minimum cost point? company value could be the exactly opposite this. At this point, company value is highest. This is the WCC, this is the value line. This is the debt and equity proportion. Then at this minimum weighted average cost of capital, we can expect the highest value of the company. So at this point, company value can be estimated. Then we can estimate what is the total value of the company at different levels, and at this particular optimal level, what is the company value. So here, corporate value for weighted average cost of capital, weighted value of debt capital 20%. Taking one particular point here, optimal value equals free cash flow 1 plus growth rate divided by WCC minus growth rate. If you remember, the growth value here, if the growth rate is 0, here indicate the growth rate of dividend is 0. Growth opportunity is 0. So investment in capital is 0. So free cash flow to firm, take this equation value, free cash flow into 1 plus growth rate WCC minus growth rate. So according to the constant growth valuation model, the growth rate should be sometimes maybe 0 value or maybe something else. Replacing the growth rate and the other parameters, we can estimate the company value. At this particular point, net operating profit after taxes $500,000 multiplied by 1 minus 40% taxes, 300,000. So here given the net operating profit after taxes is before and after taxes. So before taxes 500,000, then after taxes it becomes 300,000 rupees. Then after taxes company profit 300,000 divided by, at this particular optimal level, cost of capital is 11.28%. No, at this particular 20% rate, 11.28% rate. At this debt level 20%, weighted average cost of 11.28% rate. Here substitute 300,000 is after taxes divided by 11.28% minus growth rate is 0. Then ultimately the value becomes here 2,659,574. Similar way, we can calculate the company values here. At different levels, weighted average cost of capital. So this is the optimal level. At this point, corporate value becomes here 2,724,796. At 20% debt capital, 2,659,574. At 12%, 0% debt capital, 2.5 million. At higher debt level here, 50% corporate value becomes here 2,631,579. So comparing among these different debt levels, the highest value represent here at this particular optimal level. That is the highest value of the company. Then in order to derive these particular parameters, now we have a structure here. One point is unlevered beta. We know that unlevered beta is 1.0. So in such a case, if the company increase the company debt structure here, debt capital, maybe 20%, maybe 30%, maybe 10% likewise, then we can estimate this levered beta. Levered beta based on the Hamada equation. Then we can estimate the cost of equity capital based on the sometimes based on the capital asset pricing model. At this level, if the cost of debt capital is given, then the rate can be different. At different debt level, the rates can be high rate. Depending on their demand for money, the debt capital may have more cost of debt capital. Taking those informations and estimating the cost of equity capital and the levered beta, we can estimate the optimal capital structure. If you know the optimal capital structure, at that point, at optimal debt structure here, we can observe the highest company value of the firm. So at this point, based on these parameters, based on the capitalizing the value, free cash flow T plus 1 divided by WCC minus growth rate. If there is a free cash flow here, estimations based on the company operating profit, we can calculate the free cash flow. So we have to consider adding 1 year forecast next year free cash flows. So however, that value should be divided by weighted average cost of capital minus growth rate. If the growth rate is 0, then divide by the WCC. Then we can derive the company value. At different debt levels, we can estimate the value here. At different debt levels, then we can divide by different WCC values and then get the different values here. Then we can find the optimal value of the company. That is the highest value of the company. Then resulting debt and equity capital, the weighted average cost of capital, behave like here, WCC, this is the minimum point. At this point, with the same debt and equity parameter, we can observe the highest value of the company. So this is called optimal capital structure. I think you can simply understand this sort of estimation process, calculations. Think of some particular starting point, unlevered. With that unlevered conditions, what are the changes? What are the changes in other parameters? And then ultimately you can estimate what are the particular the cost of capital at different levels, and then at different levels what are the company different values. Then you can find the optimal capital structure here. But molecular and meter theory explain even if there is a changes in the debt and equity capital here, different changes, we can't find the highest value point or minimum cost point. Then the company so based on the estimations here, molecular will explain no changes in corporate value when there are changes in debt and equity. Result in that ultimately we can say that this is a molecular Miller explanation. At this point, we can't find the minimum cost point. Then the cost is parallel to this line. Then the value line also, at this different debt and equity capital, we can find the some particular level. Value. This is the value in rupees. This is the cost in percentage. Then here it says that according to molecular theory, value is not depends on the debt and equity proportions. Value is not dependent on the weighted average cost of capital. That according to the capital, the particular optimal theoretical explanations, we can find here minimum cost point, WACC. There's minimum, the minimum first price, then we can find the optimal capital structure. At this point, company value is the highest value.
Is the red one also MM theory?
So that is actually there was some traditional explanations based on this particular optimal one. But in 1958, molecular Miller introduced no optimal one. This is a no optimal. But realizing the inappropriate assumptions here, molecular Miller also released certain assumptions. So releasing that assumption, ultimately they explain taking the trade-off explanations. Trade-off. Then according to that, then there's a optimal capital structure. That was the result. Releasing that back of the cost, market equilibrium, investors' expectation, similarly investor expectation likewise. Releasing those assumptions, ultimately we can find the optimal debt capital. That is also introduced by, extended by the molecular Miller. That is not much highlighted, but according to the theoretical explanations, molecular Miller explained this particular irrelevant explanation. Irrelevant theory. Normally, theoretically, when you discuss the theoretical development, molecular Miller emphasizes the irrelevant theory, no optimal capital structure theory. But later on, with taking the trade-off explanation, we can find the optimal capital structure. That is also explained by same authors, incorporating the back of the predictions, because likewise, introducing that, they realize that there are some trade-off benefits. Optimal capital structure.
Recording in progress.
So in addition, there are some other theoretical explanations. One is the speaking node explanations. If you observe the Sri Lankan conditions, if you need the fund for different investment, then what is your first steps? Normally you think, what are the possible avenues for the company? They observe whether the company has during the past retained earnings. If they have retained earnings, first they can use that retained earnings. Then if they don't have saved money within the company, then they try to get some external funds. Then the external funds can be debt issues or maybe equity issues. So among these two, then they consider what are the most appropriate source that may be lowest depending on the issuing cost, low cost of capital. They select the particular method. Then normally the debt capital is the second alternative. If they need the further capital, they can go for equity shares. So that is the normal practice, hierarchical structure. They don't consider the theoretical explanations. They don't know even the molecular theory. In addition, there can be available market opportunities. They observe what are the market opportunities available. So nowadays you can think of different interest rates conditions. Then not to issue the debt capital, but they can raise equity capital. if they issue the debt capital, they have to pay more interest charges. What is the after found value of the firm, how to find the value of debt and equity amount separately. Why you can calculate that value based on the proportions. No? For example, how do you get that? Then normally we have to take the particular parameter here. Value of the, say for example, debt proportions 20% debt capital. Uh, then the equity capital becomes here 80%. So among that particular value, capital structure here 2,268,000 something. No? You can divide into 20%, 80% here. Or otherwise you can take here capitalized value of debt, interest charges capitalized by the cost of debt capital, equity value dividend of free cash flow divided by weighted average cost of capital, no, cost of equity capital. Capitalizing particular compensations. Interest charges capitalized by cost of debt capital. Free cash flows available to the shareholders divided by cost of equity capital. Or if you know that the particular total value proportions is there, then 20%, 80% we can allocate among these two. Anything else? Now, in addition to lecture sessions, we have to have some midterm exam. And then assignment also, we can allocate some topic. First of all, we can arrange some midterm exam. I will inform in the asking some other group also. I can't remember the last time what we did. There was one particular date. We can arrange some midterm exam, 1 hour paper online, Saturday, Saturday or Sunday. I think some people, the weekday students, they can't attend the weekend classes. Some. I don't know what is the possible other alternative date. Mm. In the meantime, I will announce some particular topic with some guideline. You have to give some submit some assignment. I
So,
think
excuse me,
yes.
sir, due to these power cuts and all other those stuffs, so
Yes.
is it possible to have a continuous assignment? It means like a group activity to cover the whole marks. I'm not sure. So if it is possible, that is very much helpful for all the students.
Explode in the midterm.
Yes, sir.
Group assignment, then we have to normally the control assessment normally we allocate 50%.
Even with the presentation, no issues, sir.
Then yes. Then we have to take the presentation, no?
Yes, sir. So if the time is a matter, no issue. We can do it after the examination even. So soon after the examination, next week also we can do.
Okay, I will decide that I have to think of the way of doing that. What is the possible assignment? With the prevailing condition in the country, the interest rates is very high. The share market investors, how they feel that concern in that investment point of view. There may be one particular possible way. Then, otherwise I can give you some other different kind of assignment, like if you can propose any particular way of getting solution for the country prevailing conditions, foreign currency or maybe dollars reserves, or the other part may be the debt components. We can ask some question from that area.
Yes, I think that would be ideal because since we are
Yes.
having a pathetic situation in the economy.
Yeah. Then you have to gather information from the market, from the other countries, from other research outcomes, likewise, collecting from some IFM informations. So you can take some experience from some other similar countries done during the past period. So I will arrange some guideline and some by next week I will give you some exact way of doing that.
Okay, sir. Thank you so much.
That may be very important, I think. So depending on your capacity, your interest, that may be very interesting. And then after the examination, you have to make a presentation. No?
Yes, sir. Sure. Thank you so much.
Okay, I will think of that.
Thank you so much for accommodating our request, sir. Thank you so much.
Okay, thank you very much. Now we can stop now.
Record.